Have you ever wondered if there's a secret recipe to successful investing? Well, here's a little secret. There isn't one. But don't let that discourage you. In fact, it's quite the opposite. There are two main strategies that investors use to navigate the world of finance: passive and active investing. Each has its own unique approach, and understanding these can be crucial in shaping your financial future. Imagine having a roadmap that can guide you through the bustling city of finance, helping you make decisions based on your own financial goals, risk tolerance, and time horizon. That's what understanding passive and active investing can do for you. They are like two different roads you can take on your journey to financial success. So, are you ready to learn more about these strategies and how they can potentially amplify your financial growth? Welcome to Cash Nest. In today's video, we'll dive in to unravel the mysteries of these two investment strategies. Imagine setting your investment strategy on cruise control and watching it grow over time. Welcome to the world of passive investing, a strategy that's akin to planting a seed and patiently waiting for it to grow into a tree. In the realm of finance, passive investing is an approach where you invest in a broad market index or sector and hold on to it for the long haul. It's like being a passenger in a car, enjoying the journey without the stress of driving. One of the key characteristics of passive investing is its hands-off approach. You're not constantly buying and selling stocks based on market trends or economic forecasts. Instead, you're trusting the market to do its thing over time. It's about riding the wave, not trying to outswim it. Now you might be wondering, why choose the passive route? Well, for one, it typically comes with lower fees. Since you're not frequently trading, you're avoiding those pesky transaction costs that can eat into your profits. Moreover, passive investing doesn't require you to be a financial whiz or spend hours glued to the stock market news. It's a strategy that's accessible to everyone, whether you're a seasoned investor or just dipping your toes into the financial waters. But perhaps the most compelling reason to consider passive investing is its potential for long-term growth. It's not about getting rich quick. It's about building wealth steadily. The magic of compounding, where your earnings generate even more earnings, is your best friend here. So, who might find passive investing appealing? If you're a long-term investor who prefers predictability over speculation, if you value peace of mind over the thrill of the chase, or if you simply don't have the time or inclination to actively manage your investments, then the passive route could be your path to financial growth. Remember, investing isn't a one-size-fits-all game. It's about finding a strategy that aligns with your financial goals, risk tolerance, and lifestyle. Essentially, passive investing is a marathon, not a sprint. Now, picture being in the driver's seat, maneuvering your investments around the market's twists and turns. That's the essence of active investing. It's a hands-on approach that requires a firm grip on the wheel and a keen eye on the road. Unlike passive investing, where you're a passenger on a long, steady journey, active investing puts you in control, navigating through the market's ebbs and flows. Active investing is all about making strategic decisions. Think of it as a chess game. You're constantly analyzing the board, planning your next move, and adjusting your strategy based on your opponent's actions. In the world of active investing, your opponent is the market, and the goal is to outperform it. One of the most enticing aspects of active investing is the potential for higher returns. Imagine spotting a promising startup or a forgotten gem and watching your investment skyrocket as others catch on. That's the thrill of active investing. It's about seizing opportunities, making calculated risks, and reaping the rewards. Now, let's talk about the flip side. Yes, active investing can lead to higher returns, but it also comes with higher risks. Remember, the market is unpredictable. Today's hot stock could be tomorrow's flop. That's why active investing requires a certain level of expertise. You need to understand market trends, interpret financial data, and make informed decisions. And let's not forget about the time commitment. Active investing is not a set-it-and-forget-it strategy. It demands regular monitoring and adjustment of your portfolio. It's like tending a garden. You need to water the plants, pull out the weeds, and sometimes even replant. So, who might be drawn to active investing? It appeals to those who enjoy the thrill of the chase, who have the time and knowledge to monitor the market closely, and who are comfortable taking on more risk in search of higher returns. In essence, active investing is like navigating through a dynamic labyrinth. It's a journey filled with twists and turns, challenges and opportunities. It's not for everyone, but for those who embrace it, it can be a rewarding adventure. So, how do these two strategies stack up against each other? Let's dive right in. First, let's talk about risk. In the world of investing, risk and reward often go hand in hand. With passive investing, the aim is to mirror the market. So, your investments will rise and fall with the market, but the overall risk is generally lower. Think of it like going with the flow of a river. You're not trying to swim against the current, you're just floating along with it. On the other hand, active investing involves more risk as you're trying to beat the market. It's a bit like trying to paddle upstream. There's the potential for greater reward if you make the right choices, but there's also a higher risk of getting swept away if things don't go as planned. Next, let's consider return. With passive investing, your returns will typically reflect the overall market performance. So, if the market is doing well, so will your investments. But remember, the opposite is also true. Active investing, however, offers the potential for higher returns. If you or your fund manager makes smart decisions, you could outperform the market. But this also means you could underperform if the decisions are not sound. Now, let's talk about time commitment. Passive investing is a more hands-off approach. Once you've set up your portfolio, you can just sit back and let it do its thing. It's like planting a tree and watching it grow over the years. Active investing, however, requires a lot more time and effort. You need to constantly monitor the market, research individual stocks, and make timely decisions. It's more like tending to a vegetable garden where you need to water the plants, pull out the weeds, and harvest the vegetables regularly. Finally, let's discuss cost. Passive investing generally has lower fees because you're not paying for someone to actively manage your investments. It's kind of like taking a bus. You pay your fare, and off you go. Active investing, on the other hand, usually involves higher fees because you're paying for the expertise and time of a fund manager. It's a bit like hiring a personal chauffeur, you're paying for a more tailored and hands-on service. So when we lay it all out like this, it's clear that both passive and active investing come with their own set of advantages and disadvantages. Which one is right for you? Well, that really depends on your personal goals, risk tolerance, and the amount of time and effort you're willing to put into managing your investments. As you can see, both strategies have their pros and cons. It all boils down to your personal goals and risk tolerance. Remember, the best investment strategy is the one that aligns with your financial goals and risk tolerance. So, take the time to assess your situation and choose wisely. Now that you understand the basics, how do you decide which strategy is right for you? Choosing the right investment strategy is a bit like choosing the right pair of shoes. It's all about comfort, fit, and where you plan on going. Let's break it down. Firstly, consider your financial goals. Are you saving for retirement in a couple of decades or planning a down payment on a house in the next 5 years? If your goals are long-term, a passive approach might suit you better. Next, gauge your risk tolerance. Are you comfortable with the roller coaster ride of the stock market, or do you prefer the steady climb of an index fund? If you're the type who loses sleep over market fluctuations, a passive strategy might be more your speed. Lastly, think about your time horizon. Do you have the time and energy to constantly monitor your investments and adjust as necessary? If you'd rather set it and forget it, passive investing might be the way to go. However, if you're up for a challenge and are willing to put in the effort, active investing can potentially yield higher returns. It's more hands-on, and there's a thrill in trying to beat the market. Remember, there's no one-size-fits-all answer. It's all about what works best for you. So there you have it, a primer on passive and active investing. From understanding the hands-off approach of passive investing to the potential high returns of active investing, it's all about what suits your financial goals best. Remember, there's no one-size-fits-all when it comes to investment strategies. It's about understanding your risk tolerance, time horizon, and financial objectives. Stay curious, keep learning, and remember to subscribe for more financial insights. Until next time, happy investing!